Good morning, everyone. Welcome to Columbia University's 19th Annual Social Enterprise Conference, our Capital for Good digital event series. Obviously, during the pandemic, we're all online. This series is intended to showcase social impact leaders who are deploying capital to generate sustainable solutions to the massive global systemic challenges that we're facing today. So we hope today's event and all the events in this series, both upcoming and ones that have been recorded, showing on our YouTube channel, will serve as a hallmark for creating a virtual space in this online world, but on campus and connected to Columbia for the exchange of new ideas and best practices from mission-driven business leaders and social impact leaders in lots of different sectors. As a reminder, I've shared this slide before. This is a slide that I think will be familiar to those of you that have looked at the impact investing space. When we think about what is the spectrum of capital for good, we intentionally cover the full range as part of this series and in other Capital for Good programs that we run, for example, course teaching and the rest of it. So everything from ESG and impact investing, strategic philanthropy and pure philanthropy. We think you need all the tools in your toolkit when you're tackling these really complex challenges. And to some extent at the Tamer Center, we're somewhat agnostic as to which tools or which area of the field people decide that they want to focus on. But we need more of all of it because just as a builder is trying to build a building, you have a whole series of tools in your toolbox. It's not that you love one or another more, but that collectively we need to know how to use all of the different things at our disposal and to collaborate, obviously, across sectors. So we're very interdisciplinary in our perspective at Columbia Business School around this spectrum of capital for good. So I just wanted to show this as a way to orient us in terms of where the discussion might focus on today. We obviously don't cover all of the topics in every single session, but throughout the whole series that you would get exposure to all of these different topics. So with that, I would like to stop the share and Matan, if you can show us the any other slides that you might want to put up on the screen. Today, we're going to hear from some terrific leaders, really excited for this panel and all the discussions today, focusing on impact investing and also scaling social ventures. We have some really stellar speakers. And then we're going to follow up with a virtual networking event on a different platform. So bear with us with, we're trying something different to Zoom. So if you can join us after the sessions for some virtual networking, I think you'll have an opportunity to meet people who are also drawn to these topics. So with that, I'd love to introduce Juanita Paul. She's one of our STAR Social Enterprise Conference co-chairs to join me on stage. Juanita, over to you.
Thank you so much, Sandra. Hello, everyone. Thanks a lot for joining us this morning or evening, wherever you are in the world. I'm Vinita Paul. I'm one of the panel organizers for the Social Enterprise Conference Capital for Good, which we are holding in a digital series this year. I'm also a graduate student at Columbia Business School and at School of International and Public Affairs. It is my pleasure to host our esteemed panel of impact investors today for a discussion on the experience and performance of seasoned institutional investors in the growing field of impact investing. Joining us today, we have John Goldstein. He's the head of the Sustainable Finance Group at Goldman Sachs, where he works across the firm to deepen its knowledge and grow its capabilities in relation to inclusive growth and climate transition. John joined Goldman Sachs in 2015 through the acquisition of Imprint Capital, which he co-founded in 2007 to help expand the firm's ESG and impact investing capabilities. We also have with us Vikram Raju. He's the head of impact investing at Morgan Stanley, where he is responsible for emerging markets and impact investing for AIP private markets. Prior to Morgan Stanley, Vikram was a principal investment officer at the International Finance Corporation at World Bank Group, where he led the investment program for climate-related private equity funds across emerging markets. Aside from that, Vikram is an amazing mentor. We also have Iain Ware. He's the managing director of Bain Capital Double Impact. Prior to the Double Impact team, Iain worked in Bain Capital's private equity European team in technology, media, and telecommunications vertical, where he focused on investments in the software, financial technology, information services, and media sectors. And we'll be having Megan Starr as the moderator for the discussion. Megan is the global head of impact for the Carlyle Group, where she works to design and execute Carlyle's cohesive long-term impact strategy and oversees the dedicated ESG team. Prior to joining Carlyle, Megan was within Goldman Sachs Investment Management Division, where she helped build the ESG and impact investing business and held roles at the JPB Foundation, a private family foundation based in the New York City. Over to you, Megan.
Thank you so much. And thank you for having us. I think it's hard to look at headshots of what we all used to look like when we were professionals that lived in offices. But I'm very excited to be here today. I'm joined by some old friends and some new faces. My name is Meg Starr. I look over our ESG and impact work at the Carlyle Group. And to kick off today, instead of typical intros, I think it's a Friday and we're talking to a lot of people who are at various stages in their own story. And so John, Iain, Vikram, I'd love to start with some intros from each of you, but I'd really love to hear the story about how you ended up in the impact world. So John, since I know I can pick on you as the little Midwestern boy that got acquired by Goldman Sachs, maybe we'll kick off with an intro from you.
No, and the part that's not in the bio is acquired at Goldman Sachs by Megan Starr.
I wrote the check personally.
One of those big cardboard checks kind of under her arm. It was amazing. So my path is this funny one. I grew up in the Midwest, went to college out east, was going to go to grad school, never quite turned in my grad school application, took a job, did various things and got to work for and then run a fascinating company that the person who founded it also happened to have a penchant for giving things to nice people. And at that time we had a 25,000 square foot loft in Tribeca. And the thing he gave to nice people was he gave some really interesting NGOs some office space who were working on these fascinating questions, solving problems that were important around poverty, around climate and others, but trying to figure out how to use market mechanisms. And so, created this thing we called the Medley Institute as a way to tap into that, fascinating. And when we sold our business to private equity investors, to one of Meg's peers, we wanted to figure out what next. We said, let's do something with the Institute. So we looked at that question of how do you scale this ability to use market mechanisms in an impactful way? And these two worlds that didn't always talk to each other. And when they did, they didn't always get along very well. And so that led to moving out to the West Coast, trying to figure out what to do. And in the same week, the Kellogg Foundation, Google.org, and a big family office all said, can we pay you to help us figure out this whole mission investing thing? And I would trot out Taylor Jordan, who at the time was chief investment officer of the Ralph Steiner Foundation and had quietly and methodically built a 100% mission-aligned investment portfolio. And he did it in a way that looked suspiciously like investing, right? This is a field that look at, the types of organizations that are participating now. Let's just say you wouldn't have had these organizations represented on a panel back in 2007, right? This was at that point, this was thought of as slightly more fringe. But, gradually worked with foundations, families, other types of institutions. And then some financial institutions started hiring us. So we have actually a huge debt to Morgan Stanley, who really, frankly, worked with us to help us up our game dramatically as a partner. Learned a ton from them and their leadership really in the space. Little old imprint started working with financial institutions. Then one of those institutions said, well, instead of becoming a client, why don't we just buy you? That was my morning coffee spit take moment back in early 2015. But eventually we decided we couldn't think of a better way to grow our mission than as part of Goldman Sachs, because we wanted to move more money impactfully, do a better job, right? So we're either do this well and create proof points, or we do it poorly and we create cautionary tales. And as we all know, people remember those cautionary tales for a long time. I see all these knowing nods for the panelists of we've all been in a meeting with some investors who said, well, back in 2007, I looked at this clean tech deal that didn't work out very well. And it's, so we were determined, and we want to make it accessible to more people. And a little bit of a sign of how this has grown, working with Meg and others, to help grow the ESG impact business within just the asset management division of Goldman. And this is all as this is kind of marched from the periphery to the core, right? So one division is a $3 billion business. Now it's about an $80 billion business. And then I got asked a couple of years ago, to work with our leadership to figure out, this is showing up everywhere. So what's next? What do we do? And that led to what I do now, which is I run the Sustainable Finance Group. And we can talk a little bit more about that as the conversation unfolds.
Awesome. I literally just got out of a meeting where someone was giving me the argument that if you'd stayed invested in tobacco in the last 10 years, you would have made a killing. I was like, that's really not what we're talking about. Thank you. Thank you for the argument. Vikram, it's so nice to see you. I think the last time we hung out in person in the weird world, it was in Hong Kong, which I can't believe they used to let us do. So thank you very much. And I would love to hear the story, because I've actually never heard it before, about how you ended up in the position you're in.
Well, it's good to see you, albeit on online. So my story is I grew up in India, which is where I am right now. It's what is it, 9 o'clock at night, 1:45, and went to Columbia to go to grad school. So I was at SIPA in the last half of the last century. There were still sort of phone booths on campus, and found my way via Lazard and McKinsey to the World Bank, to IFC. And that was a really neat place. They were consistently deploying capital in some of the toughest parts of the world, which needed catalytic capital. And they made great returns too, because they were precisely doing, counterintuitive and counter-cyclical investing, which everybody talks about, but people rarely do it. And it was in their mandate to do it. So it was actually, as I said, it was a very neat experience. And then the guy who was the climate finance lead wanted to leave, and he said, "Do you want the job?" And I said, "Look, I'm already doing impacty stuff here. I mean, do you really want me to go and kill myself doing climate?" As John said, there are all those horrible stories about how clean tech blew up and these renewable energy deals were heavily subsidized and so on. But the bank made a compelling argument. They said, "Look, the problem hasn't gone away, right? Somebody has to do something about it. If what was done previously, and a lot of bad stuff was done, just go and figure out a way to do it differently." So with the benefit of looking at a big portfolio of car wrecks, we were able to just sort of re-envision what a climate investing strategy, which would make money, which didn't rely on subsidies, which didn't rely on do-gooders, which didn't rely on belief that all of us would have massive changes of heart, could actually make sense. And that evolved into what we do today, which was a combination of very agnostic climate portfolios that do everything from oranges that are grown with irrigation systems that save water, to software systems that reduce the amount of energy they consume, to financing in India where people are paid to install solar, so they shut the diesel generator down and so on. And we'll take it in any form we can get. It's sort of sustainable ag, it's food, it's transportation, it's building materials, it's textiles. And that was the big transformation there. And along the way, Morgan Stanley in 2009, another Columbia alum, James Gorman, decided that the firm was going to set up a sustainable finance initiative, sustainable finance team, which today is 40 people strong, with experts in all areas of sustainable investing. And they came to the bank, to the World Bank, and they said, you're doing what you're doing. How about you always talk about catalyzing private sector capital. Why don't you come to the private sector and do it here? And so that's how I ended up in this team that is doing a range of impact investing in private markets, but very heavily focused on climate in all flavors.
Very neat. And Iain, I'm so excited to meet you virtually. And so I think a great place to start is the story of you. Feel free to throw in any of your favorite childhood memories as well.
Sounds good. Great to meet you as well, and great to be here today. I similar to what John was saying, I was an undergraduate studying economics and had an interest in public policy and thought I was actually going to go down the academic route. I think like a lot of people, sort of junior year, senior year in college was, exploring options, didn't really have any context or understanding of what a business career could look like, was getting my applications ready for grad school. And suddenly all these investment banks and consulting firms showed up on campus and started recruiting, and friends, were looking into that and ended up getting really excited about the idea of starting my career in consulting and the kind of the breadth of the skill set that could bring. So I went off to McKinsey, similar to Vikram, and spent a few years there, had a great experience there, found my way from there into kind of growth equity, private equity investing. Kind of after going through those experiences, felt like there was a lot that, my eyes had been open to and a lot of things that were really interesting about those roles. But I still had this kind of long-term passion to find a way to bridge the sort of consulting and investing skill set with actually being able to address the big social and environmental issues that all of us are facing. And so had this, I'd wrote a business school essay about this vision of, what it kind of is impact investing. It wasn't quite how I articulated it at the time, but was sort of a long-term aspiration of mine. And ended up joining Bain Capital after that and spent a number of years in regular way private equity, doing mainly technology and tech-enabled services investing. But then suddenly in sort of 2016, 17, I think a greater wave of momentum around impact investing generally, but for Bain Capital specifically, Deval Patrick, who was governor of Massachusetts for 2 terms, was finishing up his term in office. He came over to join Bain Capital really with a vision of how can we bring all of what private equity does, what Bain Capital likes to think that it does well in terms of helping build great businesses with an active ownership mentality, partnering with great management teams, and how can we bring all of that resources and capability, but specifically focus on helping empower companies that have a social or environmental mission at their very core, and help them maximize not only the business and financial aspects of their operations, but also very intentionally focus on measuring and driving impact, and maximizing the positive impact that those companies are having on the stakeholders that they serve. And so to me, it was kind of exactly what I've been looking for, but thought it was going to be maybe a little bit, further down the line in my career. So I put my hand up and said, I'd love to be part of that. And I came over about 6 months after the first fund was raised to help kind of fill out the leadership team. And a couple of my colleagues and I came over right around that same time. And so, been with the fund about 3 years, and happy to go into more detail on all of it. But really, it is very much that focus that I was alluding to, which is a double bottom line strategy, both focusing on building great companies that are have long-term sustainable differentiation and competitive advantages, but being really focused on how do we also maximize the positive impact that they're having, on their various stakeholders, and working closely with management teams to drive both sides, both the financial piece and the impact piece. And so within that, maybe the last thing I'll say is I spend most of my time around what we call education and workforce development. We have kind of 3 pillars: health and wellness, sustainability, and education and workforce development. And I spend most of my time around education and workforce, but also get involved in some of our sustainability investing as well.
Very neat. I think one of the common themes I see across these stories is that there are very few common themes across how people make their way to impact careers, but it feels like it takes a little bit of business acumen and financial literacy, a lot of interest in the space, and I think a lot of creativity, because I say this as, people come to talk about potential jobs in the space all the time. It's not like you enter the 2-year analyst program and then graduate right into the impact investing job. This route is circuitous, and there are a lot of different opportunities. And so, as John alluded to, John was my shaman/boss for many years, which I could not be more grateful for. But one of my favorite Johnisms was impact is a process, not a product. And I love that concept. And one of the things I want to ask for each of you is that a lot of times in impact investing, we get into this binary of like, this is a good guy company and this is a bad guy company. And you can only invest in these companies and you are not allowed to put capital into those ones. But some of the investments I find most interesting are in this thesis of change over time, and companies that may not scream impact on their surface, but by dint of your capital, your expertise, your time, you can really shift that business model. I give an example a lot from the Carlyle portfolio. We invested in 2018 in this company called Axle Tech, 100-year-old conventional manufacturing business for in-axle powertrains. On the surface of it, it's not an impact company, it's a manufacturing company. But we saw this shift of the electrification of the vehicle fleet. And so we put about $20 million more into the company to design and prototype an in-axle electric powertrain for Proterra, which I think, did Goldman recently take Proterra public? And that ended up being the growth driver for the company, so it sold at a great exit. And that was really the transformation story. And so Iain, maybe I'll pop back to you guys quickly, because I know one thing you focus a lot on is things like B Corp certifications and how you can help evolve a company over your hold period. So I'd love to hear any examples you might have of a company that wasn't necessarily impact, but you were able to shift towards that.
Yeah, absolutely. And I think it's a great point, because I think that is, so certainly a lot of what we focus on is, obviously that there's kind of a baseline level of impact screening, but it's less around exactly what the company looks like today and more what the full potential could be and how could we help potentially bring the company in that direction. I think, one that comes to mind that I always like to talk about is we invested in a pediatric dental business down in kind of the South and Southeast. And, on the surface, pediatric, of course, we want kids to have healthy teeth. But pediatric dentistry maybe isn't what everyone thinks of when they think immediately of impact. But what was really interesting about this company was that they'd identified a business model that actually allowed them to really serve the Medicaid population in a way that most other existing providers had not been able to really crack. And so, first of all, a lot of dentists historically don't take Medicaid, and the ones that do, stereotypically are often pretty just unpleasant customer experiences, kind of rundown buildings. No kid likes going to the dentist anyway, but certainly you don't want to go to a space that feels unwelcoming. And what this group had really cracked was kind of the end-to-end business model sort of transformation or approach or innovation, I should say, that really allows that to sort of turn the economics of that on its head and make the economics of serving the Medicaid population work. So everything from real estate strategy to kind of the operational setup. How can we increase throughput, but in a way that doesn't kind of compromise the customer experience? How can we just be thoughtful about what the spaces look like, and bright colors and toys and things that makes it a more engaging and welcoming environment for kids. And at the time we invested, they had already had a significant portion of patients that were Medicaid, but they had a real vision of this is the strategy. We really want to make sure that we can continue to serve that population and continue to roll out new facilities in a way that we can continue to offer just a much better quality of service and provide access to the needed dental care that kids need. And so, we partnered with the company, invested there, and continuing to roll out, new units and really focus on continuing to, drive that business model innovation to basically be able to, continue to serve more and more kids from underserved backgrounds and make sure that they have access to the needed services that they all deserve.
Very cool. John, any examples that stick out to you from your investing universe?
Yeah, and I mean, I think your point, I want to circle back to your question because I think it's such an important question and I would parse it into two pieces, right? Number one, people love drawing lines, right? It's in, it's out, it's here, it's there. And I think the world is more complicated, dynamic, and interesting. And I think within that, one thing that's been fascinating to me to reflect on is a term that literally was not used, didn't particularly exist in 2007, impact investing. Small gaggle of us sort of, got together because we wanted to distinguish between values-based investing, which was exclusionary, to what you're actually doing. But now people fighting about what counts in this term that we didn't even use 15 years ago is this funny thing to watch. And all of us that are practitioners see there's a wide palette of tools to use, and it's dynamic over time. And I know it doesn't make for great headlines, but examples of what are some really interesting things. So what I would argue one of the most impactful investments that our merchant bank made in the last decade is when we bought an oil and gas company. Right? We bought Dong Energy, the Danish oil and natural gas company, because what we did with it is we turned it into Ørsted, which is one of the world's leading offshore wind developers. We unlocked a huge amount of financial value. And if you look at the net carbon impact, phenomenal. But once again, if you said, we're making an impact investment, we're buying an oil and gas company, people would look at you funny, right? And so this is sort of, let's play, let's, and especially what's interesting is once upon a time, finding these poor neglected renewable stories and electrification stories and giving them capital would be really adding to them. That is not a space that is particularly capital starved. Well, it is increasingly recognized by the world as something important, so that's great. But what it means is if you both want to have greater clarity of how you're going to unlock financial value and impact, it's the change that's going to do it. So that's kind of on the Dong to Ørsted point. The second thing I would say is, product, process, all these things can matter, right? And so a good example is one, Meg, well, which is, we had a lot of corporate clients that care a lot about diversity, equity, and inclusion and want to find ways to express that in a variety of ways. So we took a money market fund we had, basic tool corporations use, and we partnered with a couple of our clients, with Apple, with JetBlue, with Starbucks, and we said, let's think a little differently. And we said, we can't change the securities that are in it because that will affect, its ability to do its job in terms of return and liquidity and security. But what we can do is we can change who we buy them from. And so we buy the majority of those securities from women, minority, and veteran broker dealers. And so this idea of, it's being thoughtful and engaged in your assets to figure out how can I squeeze more impact out of the same assets. Or even when you're allocating money to an external manager, we have a pretty extensive process of engagement around, integrating environmental and social governance, but also racial equity and gender diversity of what is an ongoing way to engage that will make them better investors and better organizations over time, but also help slowly move an industry that has a way to go. So we like to say it's kind of playing impact chess, not checkers.
Yeah, and to your point, looking at your short duration liquidity versus, big private turnaround story like Dong, different tools, but there's still creativity to be had. Vikram, you take a little bit more of a macro view because you're looking across a bunch of different funds and strategies. I'm curious how this concept is showing up in your world at all.
Sorry, I can only echo, what's been said. The things we look at don't necessarily wear T-shirts that say impact. Right? You'll go and you'll talk to somebody and they'll say, yeah, we're take an example, an orange farm in Spain. We're an orange farm. Okay, great. Are you trying to save water and reduce your water bill? We are. Are you trying to, go more organic? Just they say, yeah, we're doing it because that pays more. There's a premium in the market. We don't particularly care about the soil. That's fine. And then you work out, where the value ultimately is. If you try to exit this, who's going to buy it and who's going to pay for something. And then you turn around and say, well, you're an impact story. You may not realize it yet. And you're definitely, by the time we're, in 5 years of owning you, by the time we're out, this will be a full-blown, impact story. Like I can cite any number of examples, people who said, okay, dairy-free is a very small part of what we do, and then suddenly it becomes a huge part fast because customers move faster than the companies realize. Auto companies that said, well, electric is a very small part of it, and suddenly, boom, electric is the biggest part of it. So we're pretty agnostic when we go in. We just ask the sort of foundational questions, first principles. Do they have what it takes to get to where we want to? It would be great to get sort of the Dong kind of transformation, but even a sort of an incremental transformation where something sustainable has gone from being 5% of their revenues to 60% of their revenues is great. We'll take it.
Yeah, really interesting. One of my favorite topics in the kind of ESG and impact world is this concept of dynamic materiality. And John and I, a couple of weeks ago, we're talking about something and we were using the phrase like there's no ESG nirvana. It's not like you get to the end and you're done and you're like, this company's perfect, we're all set, we've managed all the issues really well. It's really fun to see kind of what issues are coming around the corner and what's coming up next. And I think 2020 was, in many ways a banner year for unexpected exogenous shocks to business, which I think, provide a pretty interesting analogy for other exogenous shocks like the climate crisis or, physical risks. And so, Iain, I'd love to start again with you in terms of what issues are emerging that you see coming down the pike in terms of opportunities for growth that you guys are looking at, risk to your business, where has the world shifted and what are you thinking about for the next year?
Yeah, specifically as it relates to the kind of the aftermath of COVID or just more generally?
Take it wherever you want.
Okay. Look, obviously the world has changed tremendously in the last 12 months. So as I mentioned, I spend most of my time around the education ecosystem or education training and the kind of intersection of education and employment. And, I think the way I would describe it, as I see it at least, is, a lot of what has happened there's some things that have happened over the last 12 months that are hopefully temporary, but there's, I think, a lot of broader long-term trends that have actually just been accelerated by the experience with the pandemic. So within the education world, for example, there's been slow but steady adoption of new technologies and use of technology in the classroom and kind of innovation around how technology can drive educational outcomes. But it's taken a long time and things in a lot of ways have as I said, kind of moved slow and steady. In the last 12 months, everything's been forced to be remote for prolonged periods. And so you've seen school districts and educators experimenting with a whole bunch of tools that maybe they kind of knew about, but were a little bit reluctant to think about adopting. And that's, now that they've been, forced to be put in that position, I personally believe a lot of that will persist. And so it's going to be a bit of a step change in terms of the role that technology plays within the education ecosystem, for example. And so we've spent a lot of our time over the last 12 months, thinking about things like remote learning, but also how can more, student interfacing technologies enable, basically the migration towards more personalized learning, help to identify issues that students are facing earlier, and then be able to take the right interventions to, course correct and try and maximize the learning opportunity for those students. And I think the way that technology enables that is by having that much more direct feedback loop at the student level, with things like adaptive formative assessment, and kind of building that into much more, making that much more ubiquitous across the classroom. And so an example that we've spent a bunch of time on recently is actually focusing on the special education ecosystem, which has been historically underserved by the large publishers and large general ed focused firms, just given it's a smaller part of the population. But have been looking at basically a combination of remote education tools that allow people to be able to maximize their learning outcomes, even if they don't necessarily have the right resources in person in the classroom, whether that's because of COVID or because of long-term structural shortages that exist in a lot of school districts. And also looking at things, technology curriculum platforms that are helping to create this personalized learning by having a much more student-centric learning experience with the real-time feedback loops that I was describing. And so what I'm excited about is I think a lot of these, none of these companies that I described, were born in the last 12 months, but because of the horrible experience that we've all had to go through with the pandemic, I think on the back of that, there will be a greater acceleration of some of these tools that will hopefully enable us to find ways to help bridge that gap in terms of both achievement gaps in the K-12 world, but also in the higher education and kind of lifelong learning world, help to find faster solutions for people to reskill and upskill and enable people to more successfully navigate the rapidly changing kind of workforce environment.
Very neat. And John, I think one of the fun things about your job, as I interpret it, is that you get to have pretty wide-ranging conversations with corporates and investors across all aspects of their business, from banking to investing to all things in between. What are those conversations looking like these days, and what are the things that your clients are asking you and thinking about?
Yeah, I'd say a couple of key things that I would highlight. I think number one is, and a lot of this comes out of this kind of movement from the periphery to the core, and both the joys and the pains of that, right? Which is people there are new challenges. Once upon a time, it is awareness, interest, engagement. It's like, once upon a time, it was like, how do I do something, right? Now it's, how do I do this well? And I think that those are harder questions because number one, it gets more towards the center of an organization. That's not a head of sustainability question. That's a CIO, a CEO, a board question. And so moving from the silo to the top goes, as you've seen, Meg, working with lots of organizations, that can go well and it can go not as well. And I think kind of transitioning from a world of an acronym to a thesis, right? And so, what we had to do, like I had my own very stark reminder of this. I was talking to one of our senior leaders before launching the Sable Finance Group, and I got like 4 words into saying something. And I was told, stop. Like, please tell me this is not about an acronym, right? And tell me there's something real. And I think people getting their minds around the fact that, they've been told to do this is important. They see flows, right? Here's a fun data point, like ESG ETFs, were marginal for years. In like 2017, 1% of inflows into ETFs was in ESG. 2018, it was 3%. 2019, it was 14%. And last year, it was almost 40%. Right, so have seen the growth, but going from chasing the label to grounding in a thesis. So for us, we said, look, let's step back. It's not about E versus S versus G. It's these 2 broad themes, climate transition and inclusive growth, that are massive accelerating secular themes. And the reason they matter is they will drive risk, be growth opportunities, or ways to drive efficiency, right? Losses, growing the top line, or margins, right? You need to translate economically. So I think where a lot of people are at is going from, frankly, doing ESG because they knew they were supposed to really understanding it and integrating to the organization. That's number one. Number two, with this growth, the pain points of the industry become actually painful, right? Which is, it was very academic, the fact that there are too many confusing data standards that don't make sense. That was sort of someone else's problem. Now it's everybody's problem, right? And I think getting to a world where we have better data on fewer things that matter more to support companies that get asked for too many different things, investors that are wading through lots of noise to find little bits of signal. It's sort of top of mind that everyone knows we need to get there, but I think those pain points becoming painful. And so that question of, what do I pay attention to? I had a CFO of a big company recently say, I got asked for 2,000 different ESG data points in the last year. sort some of these things into three buckets. A's, things I got to do and I got to do well. B's, things I should pay attention to. C, things I can, throw in the circular file, right? And I think that's one of the real top of mind issues for people is really how do I get my leadership bought in and engaged, which can't be about a label. It's got to be something real. It needs to be tied to your purpose, your core business, your core vision, your strategy. And two, now that I'm operationalizing this for real, oh man, how do I deal with some of the pain and some of the mess of an industry? We like to say this is the ESG adolescence, which is a period of rapid growth, great promise, and a whole lot of awkwardness, right? And so how do we get through that ESG adolescence onto our flourishing ESG adulthood as soon as we can?
Spoken like the father of two adolescents, John.
No, don't even get me started.
Vikram, I'm going to give you dealer's choice. If there's anything you want to pick up in either of those two questions, we'd love to hear from you. Or given your particular focus on the energy transition, I'm really curious what you see up ahead in the year to come. I worked at a financial institution long enough to not ask you about policy or the current political environment, so I won't. So I'll let you choose between either of those.
Well, I'll sort of split the difference. And the COVID example that I was thinking of in my head was related to food, right? Especially in the UK where we were locked down for a very long time. And if you were lucky enough to get a slot, so for a supermarket to deliver, you ended up ordering a whole bunch of stuff. And then inevitably you couldn't get through the fresh stuff as fast as you wanted to. So there was waste. And we all know that. We notice it more in these times than when we could walk to the supermarket and buy things on twice or thrice a week. Now, you know this, but for the broader audience, food waste, if it were a country, would be the third biggest emitter of greenhouse gases. And there's all kinds of shocking statistics. And it's funny, every single thing you look at apples, or you look at bananas or spinach or whatever, 50% of what gets produced doesn't make it to the table. So, you're talking about an environmental disaster, you're talking about a financial disaster, you're talking about a moral disaster, all rolled into one. So spending time on the food space, right from this very neat technology developed in California, which you spray a biodegradable material on a fruit and it just enhances the fruit life by another week, to things like, efficiency of warehousing and cold chain systems in places like India is transformational in terms of, the social impact, but also very much in terms of the environmental impact. And I think COVID, this was always an issue. It didn't show up during COVID, but it's just made it much more front and center as a result of the crisis. And then, with it comes its cousin packaging, of which we all see a lot. So I'll pause there.
Very neat. Okay, so we have 4 minutes until we turn it over to Q&A from the audience, and so we'll do a rapid fire round. I want to know what the most fun thing is that you're currently working on. I'll start to give you guys a second to think about it. The thing that I've been most excited about in the last few months that we've just started really experimenting with in the past year, a bulk of what we do at Carlyle is private equity, obviously. And when we invest in a company, we also raise debt alongside of it typically. And we really started experimenting with raising debt that is linked to those companies hitting ESG or impact targets. And so we've actually done about $1.8 billion of ESG-linked transactions just in the past year. So we just closed one this past month on a deal we did to buy a company called Flender. And we spun it out of Siemens, a big German company. And they manufacture the turbine boxes for wind turbines. And we raised about €1 billion of debt on that company. And we linked the price of the debt to energy transition targets in terms of Flender being able to roll out a certain number of wind turbines. And they get a meaningful discount on that debt if they're able to hit those targets over time. And I love moments like that of saying, exactly to your point, Iain, of this kind of, it's not an either or. What you're looking at is both of those, profitability and impact in tandem. And I love ways where Flender's profitability is already tied to impact because it's focused on the energy transition. But can we find more creative ways to use the tools of finance, kind of structure that and incentivize it? So that's one thing that I've been really excited on. But maybe I'll kick it off, Iain, if you want to go next.
Yeah, sure, happy to. I think that's a really interesting space, by the way. I think in terms of alternative financing and linking financial return directly to impact outcomes. But what I was going to say, we talked a little bit earlier around this idea that impact is about solving really big challenges, but it's also about incremental improvements in companies in other ways. And so one of the things that we've been working on is developing basically we call them playbooks or toolkits, but basically, leveraging the B Lab framework. And Megan, you mentioned that we work with B Lab, which is an organization that kind of scores companies across a range of factors related to their stakeholders. So things like governance, employees, environmental policy. And what we're working on is developing kind of a holistic playbook that we can give our companies day one when we invest in them that addresses, just some of the basic blocking and tackling type things that is really just kind of good practice for any company around employee policies. Do you have the right, policies that relates to a whole series of topics there, environmental policies, governance protocols, community engagement, and, kind of resources to drive greater, kind of grassroots engagement from the employees at the community level. And so, these are things which, they're not why we invest in a company. There's usually some bigger issue that we're hoping to solve with the company, but they're things that can bring any company, more up to speed in terms of best practices around, kind of the full range of sort of ESG topics, and really make sure that, any company, no matter what it's doing, is able to have the best possible, relationship with its stakeholders, and just be thoughtful and intentional around policies around that in a way that's easy for people and for management teams to implement right off the shelf.
Very neat. Vikram, what fun thing have you been working on recently? Oh, you're on mute. We couldn't get through this without at least one mute.
All right, so I'm in Pune right now in India, and everybody and their uncle has tried to do solar in India, and many battle scars have followed. But we said, look, it's kind of a no-brainer. Sunny place, very high energy costs. Everybody has this ugly diesel generator set. There's got to be a way you can make it work. And so we've gone through, not actually directly in the installation and generation business, we've got through the financing route. So we've gone to a small bank, a non-bank financial services, saying, show us your good credits, right? These are SME businesses, and all of these guys have diesel generators. So, help us actually finance solar loans to them, because we know they're good credits and we can get paid back. But this is something that immediately drops to their bottom line and reduces their energy cost by 50%. And our entry and exit is through the financial services side, where, historically we've done very, very well in India. So we're sort of taking financial services risk by getting climate impact. And there are a lot of metrics associated with, the valuation ratchets based on the number of megawatts that are installed.
Very neat. JG?
So, the thing I love about my job is I work with all of our clients and all of our divisions and all of our business. So I'm going to focus it in a very uncharacteristic to me way on one thing. Meg has worked with me long enough to know how truly funny that is. So back to this question of, as a lot of these themes are more widely understood and accepted, and so the sort of obvious, easy to put capital into things around climate transition are increasingly getting capital, which is really great and important. The question is, for stuff that's not quite there, how do you get capital there, which is frankly what allows you to really find value and unlock impact in different ways. And I think one of the things I like to say, and I'm completely copying from actually Deborah Schwartz, the MacArthur Foundation, who likes to say, the best impact deals are made and not found. And I think one of the things we did recently is, here's a question for the class, right? How do you get $2 billion of equity and $3 to $4 billion of financing into a company that's not going to have revenue until 2023? And we needed to figure that out for a battery company called Northvolt. And the answer is, you get $13 billion worth of purchase orders from BMW and VW, right? We all know the power purchase agreements in places like wind and solar to unlock the capital needed for those projects. But here, how do we apply that insight to other sectors that aren't at that point necessarily in the cost curve? And so, first of all, that transaction was one we're very proud of, we're very excited about. But now what's interesting is, that was interesting. How do we do more, right? What's the next Northvolt? What's the next area where, it's going to be made and not found? And we're particularly that question of offtake, of someone agreeing to buy the stuff, allows you to put more capital in an earlier phase into something that overcomes that chicken and egg problem. Because what's so great about climate transition is, so many of these things benefit from declining cost curves. More volume, lower cost, begets more volume. How do you get started, right? And so how do we kickstart those cycles? So that's one of the most exciting things that I'm working on.
Very neat. Great synthesis, John. Very impressed with the selection of one. Juanita, I think we are over to you for questions that have come in from the audience.
Thank you so much, Megan, and thanks a lot, everyone on the panel. This was such an interesting discussion that I learned a lot. We have a few questions coming in, and I would like to start with this first one, which I find particularly interesting. We touched on the topic of cautionary tales and how they go on for a really long time. Someone from the audience is curious to hear if you have had examples of investments that you made which ended up being such cautionary tales, and why, what would you do differently in hindsight?
I can do a couple of those. And it's funny, which is, this is a very small thing. So when we are having kind of we're transitioning to Goldman Sachs dinner as a team, I do this occasionally. I write songs. So I wrote a song and I performed the song. And I found the lyric sheet to the song like underneath my bed 2 days ago. And so I was going back on it. And actually one of the verses talked about are probably 2 cautionary tale transactions. So Imprint made 125 investments during its time. And there were 2 that stood out that I won't necessarily name the guilty parties, but I'll say what we learned, right? So one was a nonprofit that had this fascinating model. There were all these EPA and other loan guarantee programs to help truckers retrofit dirty, polluting trucks. The business case was amazing. It saved them money on gas, improved their incomes. It was good for low-income workers, good for air quality around ports, and good for the climate. It was great. And the moral of this story is there's a reason we now have a function called operational due diligence. So what didn't work there is literally the way they were recording the liens on the assets and securing those in a structure, they just weren't doing it right? So it was a back office documentation function. But when it went wrong, when the EPA audited, they got shut down, right? And we got our money back. It took an amazing amount of effort. Heroically, Lauren Cochran, who now is at Blue Haven Initiative and worked with Imprint, did yeoman's work to recover our money. But moral of the story is the same rigor of understanding not just the front office of the investing, but the back office, all the plumbing. So that was cautionary tale number 1. Cautionary tale number 2 was basically a restart of a rural biomass facility. And the model looked amazing. You had tax credits, you had equity, you had an offtake, you had all these wonderful things. But the moral of the story there was the leverage they had on the project put a ticking clock, and projects don't always get executed on time. And when you have, it's effectively don't underwrite to the spreadsheet, underwrite to reality, and understand leverage structure matters a whole lot. So those would be 2 specific cautionary tales, and I think what we learned back in the days of Imprint.
Thanks a lot, John. That's pretty interesting. This one is specifically for Megan. Can you comment on Carlyle's decision to have ESG and impact like other private equity competitors?
You broke up a little bit. I think you're saying having the 2 of those together.
Yeah, I can repeat. So it's just commenting on Carlyle's decision to have ESG and impact as cross-cutting themes rather than a specific impact fund.
Great. We are a little bit of a market contrarian in that way, but I actually think that we agree with more people than we disagree with. So our CEO is an individual named Kyusung Lee, and when I was first talking to him about Carlyle, he had this very specific thesis about impact. In our first few conversations, I was like, no, that's not what impact investing is. That's not how it goes. And his thesis was pretty simple. And as I got to understand it better, I really began to appreciate the kind of intellectual honesty of it, where he said, look, impact itself isn't an investment thesis. It's an umbrella term. And underneath it are a variety of very specific markets where in some cases there are very strong drivers of growth and profitability that converge with impact. Much like the themes, Iain, you were talking about that you cover, like there are real markets there that converge with real impact. And so our CEO's take was, look, when we see a market where we say, we think we have a really interesting investment thesis, we think we have the capacity to put a lot of capital to work, and importantly, we think we could build the team to prosecute it better than anyone else, we will raise capital and invest it kind of thematically in that way. So the first example of that is last year we launched a renewable and sustainable energy platform led by a woman named Pooja Goyal, and her team is squarely focused on the energy transition and putting capital into those deals. My team underwrites the carbon emissions abatement capacity of each deal as we put it through IC. I sit on our AC. It's an integrated part of our investment process. But impact isn't the first word on that pitch deck. The renewable and sustainable energy fund is. And so I would just say the distinction we take there is that we're investment thesis led as opposed to using any one of these binary fine lines. The second part of our CEO's thesis was, we're a $230 billion private investment firm, and all of our investing has impact, some good and some bad. And our job is to think of how we can use our tools as private investors to think of impact as change over time. And so exactly to John's point, how do we invest in diversified energy companies and help them really benefit from the transition to a lower carbon economy? And so I think our structure is a little bit of a reflection of the evolution of the whole space in terms of broadening out this thesis to focus on where these themes intersect with different sectors and how you can capitalize from the growth that's happening within each of them because of kind of sustainable growth trends.
Thanks a lot, Megan. That was very helpful. This one's very timely. It basically asks, how have your investment strategies shifted through 2020? And I would club this with another question on how moving to a work from home has actually impacted your own abilities to learn about newer upcoming themes.
Yeah, I'm happy to jump in there. I mean, I think certainly, I think we've spent a lot more time over the course of last year thinking about things that have, I think thinking more expansively than maybe we would have historically around, sources of disruption and the role that, things like the pandemic have created across business models. And so thinking about things that have sources of resilience or that have, greater ability to adapt to, a remote environment, but also, kind of if the world hopefully returns back to normal. And so, certainly that discussion has been, a core part of how we thought about most deals in the last 12 months. And specifically, if you see where we've invested a lot of that, not all of it, but a lot of it has been in stuff that does have a real strong, tech-enabled remote capability. It doesn't mean that it only works when it's being used remotely, but there is that flexibility to be used. For example, I talked about in the education world, it can be used in the classroom or it can be used at home if it needs to be. And having that flexibility there. I think as it relates to our team personally and sort of the investing process, I think like for all businesses, it's certainly been a challenge. I think it's worked better than probably we would have expected, but it certainly created a number of new complexities. And so, we've now done, I think 3 or 4 deals, that have been done kind of end to end, largely remotely. And so a lot of the things you would normally do in terms of, taking a site tour, meeting the management team, in person, having dinner with them, et cetera, obviously is much harder to do. And there are some things that you can, try and do similar. You try and adapt to the digital world. And so you do a remote happy hour or remote drinks with the team to try and get to know them. And that sort of works. I can't say it works fantastically well, but it works. Or you see, for example, for industrial companies, a lot more focus on doing remote site visits and the company's investing in really detailed, video walkthroughs of their facilities in a way that, nobody would have done historically. And so I think a lot of the pieces have worked fine. I think the hardest piece, to be honest, has been kind of internal team culture and keeping that going. I think we've tried to be, very thoughtful about that and kind of finding ways to get the team together on a regular cadence and make sure that particularly things like mentorship and coaching don't break down in that world. But you really got to be much more active and even more active and more intentional about it than you do normally, because those kind of natural interaction points where someone's looking over your shoulder or walks into your office to ask a question, or go grab a coffee with somebody outside of the office, those types of natural engagements don't really happen anymore. And so you just got to be really plan ahead and be thoughtful about making sure that you find the time and make the time to ensure that those types of relationships continue, particularly as for the purposes of developing younger talent and making them get the right type of learning experience and coaching and mentoring.
Thanks so much, Iain. I think as someone who's doing a virtual/hybrid MBA, I can definitely accept that culture is one of the more difficult challenges that you're dealing with.
You did a virtual internship as well.
Oh yeah, I interned at Morgan Stanley with Vikram virtually, so that too. I think the last question that I have from the audience, and then over to you, Megan, is more about how do each of your firms prevent impact and greenwashing in investments and firm-wide data on ESG funds and investments?
I'm happy to jump in there. Firstly, I think this whole discussion about impact washing is overblown. I think, if it was...
Amen, Vikram.
it would be a good problem to have, right? The fact that someone's trying to pretend to be what you're doing is a good thing, imitation, best form of flattery, etc. But then look at who's actually doing this. If you're very credible firms putting their necks on the line saying this is what we're doing and its impact and we're measuring it, you can't hide authenticity, right? The investor base is very sophisticated. They will get it, they'll look for it, and if you're not doing it, you'll be punished for it. And as John said, if you set a bad example, you set the whole cause back, a generation. So everyone's very, very careful about going in here with the right intentionality and right execution. But no one's perfect. No one was born knowing impact investing to do it perfectly on day one. So you've got to take people along a journey. And I think that's, I think the ecosystem is very important between, the investors and the asset owners and the people who are actually benefiting from the impact. And so I'd say it's a great time for students at Columbia to be looking at this. I'll very quickly say that, for those considering a career in impact investing, it is investing. So you've really got to love, finding interesting deals, structuring them, living with them through all the aches and pains, pivoting where necessary and exiting. And that's the necessary, but not the sufficient condition to do impact investing. And you also got to, want to do things that actually, significantly move the needle in terms of the problems our planet has and, the issues people are suffering from. But if you've got the second and you don't have the first, then there's something else for you to do, but it's not impact investing.
Vikram, in the many, many coffee chats that I've had with people in the field, I've heard this advice more often than I can tell you. But thank you so much. Megan, over to you for one final question before we close out.
Perfect. Well, on that topic, Vikram, I think a good transition, given the audience of people on that call today, is what is your advice for people that are interested in this space? And to give you guys a second to think, I will kick off quickly. I think one of my big pieces of advice is that there are very few pure play jobs in the ESG and impact space. And as someone who came out of business school and was desperate to work in an impact investing shop and got rejected by maybe 60, I can attest to the fact that it's hard to find your way into those roles. But I've seen many really interesting examples over my career of people who worked in other corners of finance or other corners of investing and became the subject matter expert of how ESG and impact themes were relevant to their day job. And because of that expertise, ended up building themselves a full-time role. At Goldman, while I was there was an incredible analyst in the municipal fixed income team who was thinking about the physical risk of climate change and how do you think about pension liability. He's now the global head of ESG research, right? And fixed income, something similar. And similarly on my team, there was an executive assistant in the Carlyle London office who had worked at Carlyle for about 10 years, worked her way up, was kind of a core member of one of the credit teams, took a sabbatical, was learning about ESG and impact, started volunteering for my team kind of for free in her spare time. And we eventually this year made our first full-time headcount for ESG and credit because she'd been so valuable and rolled that out. So I would just say my 2 cents are you don't need to be in the job that has impact in the title today because your curiosity and work can turn it into that over time. So anyone else wants to go next? Last words of advice?
I'll give a couple quickies, I think, to echo that. And it's amazing how it's changed, right? I felt terrible getting asked this question in 2010, right? Because Imprint Capital, like the Omidyar Network and New Island Capital were probably the 3 single largest engines of full-time employment in the impact investing space, which was an utterly depressing idea, right? I'm slightly exaggerating, but not by that much. And so people that wanted to work in it, it was hard to talk about. And I think what's great now is number one, there are way more dedicated roles in way more places, which is remarkable to see the hiring. Number 2, it's integrated in more people's day jobs, right? So part of what I do is I work with dedicated counsels in each one of our divisions of the senior leaders and people who work with them running the business, who are working on this day in and day out. When I look at my calendar, I'm not working with my sustainability colleagues, I'm working with my colleagues, where this is increasingly a core part of their day job. And that what the mainstreaming of this means for the world is also it's the mainstream of it within people's day jobs. 3 is people can opt in. Another example I thought you were going to use, Meg, was our friend Karishma, right? There was somebody who we worked with who was, on the liquidity sales team, junior analyst, who helped come up with that idea for that diversity money market fund, then helped roll it out. And, it's since grown from, probably $500 million to $4 or $5 billion. It's given a basis to engage with a whole host of clients. She then went and started trotting out, sitting with senior clients, really walking through this, and has become a deep expert in it because she saw an opportunity, she took the initiative. And so there's also tremendous chances to be entrepreneurial if this is of interest.
Vikram, Iain?
Yeah, well, I would just echo all of that. The corollary to impact investing is investing, and you have to love investing, is that all investing is going to be impact or sustainable in some way. So it's the mainstreaming of it, which is happening. But to people listening, listen to what we say, but go out there and forge your own path, because the book story is by no means written, right? So every day there are multiple different ways in which this emerges.
Yeah, I would just echo. I'm going to end up repeating what others said, but I think it's. I think I agree with you, Megan. I think it's really around find an area you're passionate about that has high impact, potential, but really build that subject matter expertise. Because I think certainly we've seen, some people, if they look at our team, some of them are people who were passionate around impact from the beginning and over the longer trajectory of their life. Others are people who are deep investors and experts in industrial areas or in energy more broadly, but then came to really build that passion around impact over time. And because they had that deep expertise and skill set, we're able to transition into impact investing over time. And so I think it's around picking those subject matter areas where there's a lot of impact potential, building that expertise, and then hopefully finding a way to really marry both the subject matter expertise and the impact opportunity.
Awesome. Well, Iain, Vikram, John, it was a pleasure to spend a Friday with you. Thank you to Columbia for having us. And Juanita, we'll turn it back over to you.
Thank you, everyone, for joining us today. And on behalf of the Tamer Center for Social Enterprise and the Conference Organizing Committee, I would like to thank our speakers for joining us, as well as Juanita, who organized this star-packed panel. We will be taking a coffee break and returning to Zoom at 11:30 a.m. for a discussion on scaling social ventures with Jeffrey Hollander, board chair and co-founder of the American Sustainable Business Council and former co-founder and CEO of Seventh Generation, who will be in conversation with Vikram Raju, managing director of Axion Venture Lab. Following our panels today, we will convene together on AirMeet for a networking session with fellow attendees. Thank you and have a great day.